All right, folks, this is primarily for third and seventh period econ classes, and that I did this for my Friday eighth period econ class, or sorry, second period econ class. But I just wanted to go through these problems before you take the second chance this week or this weekend. So the FRQ for the consumer choice exam included these questions. The first one was about the government of Turtwig Land imposing a per unit sales tax, and the supply curve is upward sloping. You need to read every piece of this word of these questions to make sure you know exactly what you have to do. So you have part A, part B, and part C. In part A, in the market for Pokemon, consumers buy the same quantity no matter what the price is. So you have to graph that. And then what happens if you add that tax? I'm going to show you that in the next slide. The second part of the question was, in the market for hybrid cars, the market demand curve is perfectly elastic. So that is perfectly horizontal. So graph that, and then how is the burden of tax distributed between buyers and sellers? And this phrase, distributed, confused some of you. We'll talk about that in a minute. And then finally, in the market for breakfast cereal, the market demand curve is downward sloping, meaning we're in a normal downward sloping demand, upward sloping supply. Using a correctly labeled graph, show the area that is total tax revenues. All right, so the various versions of these include, let's see, I have the answers here as opposed to me drawing them. Okay, let's fast forward a bit. There we go. The first part of this question, Turtwig Land, where there is consumers buy the same quantity no matter what the price is. That means we have perfectly inelastic demand curve, which is right here. We have a supply curve. Make sure you label your graph everywhere. And then we have to have equilibrium at the very beginning of this problem, which is Q star, P star. Then, if we have a per unit sales tax, it's like another supply curve, but we label it S plus tax. Then we can see the price goes up to this point, and I labeled it P tax over here. And the question is then, who actually pays this tax? And the answer is not one group pays more than the other. The answer is the tax falls entirely on the buyers. If you noticed, the supplier is still getting their price that they originally were at the equilibrium price, and the buyer is paying the new price with the tax. So the answer was 1 point for showing this entire graph. Congratulations. And then also showing the full amount of the tax and answering this part of the question right here that I just underlined. The tax falls entirely on buyers. So that was the first question. If you said it was more on buyers, less on sellers, you did not get the second point. Second question, in the market for hybrid cars, demand is perfectly elastic. That is the E, right? When we label that on the graph, E horizontal, demand curve is elastic. So we start with the supply curve, and my translation here from PowerPoint to wherever we are didn't work. So here's our Q star, should have been somewhere around there, equilibrium, and P star here. Now, what happens when there's a tax? Well, the tax supply curve shifts to the left. It's to the left. I don't really shift it. And we label that S plus tax. Not just S2, but S plus tax. If you did S2 plus tax, I'd be okay with that. So now we're hitting this demand curve here, where we already hit the demand curve at that same price. I mean, the supply curve and the supply plus tax hits the demand curve here. It is the same price with the tax as it was at equilibrium, which in this case means the supplier is the one taking the hit. So if we were to look here, probably should have Q supply down here, or Q after tax right here. This is the price the seller gets. This is the price the buyer pays. That entire tax is absorbed by the seller. So if you look over here for the answer, it says you need to draw this graph with the horizontal demand curve. The tax falls entirely on sellers. Entirely is the word. Completely on sellers. The third part of this was, in the markets for breakfast cereal, we have a demand curve downward sloping, and remember, we have a supply curve that is upward sloping. It's our normal graph, right? So we have supply and demand with the original Q star, P star, Q prime, P prime, whatever you want to label it. Then we add S plus tax, and then we see that we hit demand curve up here, and I've been trying to harp on you or push you all to make sure you write P tax, or maybe this is P buyers, whatever you want to call it. And then the difference here is that sellers get this price, and the amount from here to here is is the tax itself. That's how much the tax is. So if we want to know, and we probably should do this just to be careful. There's my Q with the tax. I know anywhere from the price the buyers pay with the tax to the price the sellers receive is the total amount of tax. Therefore, this entire rectangle is the tax revenue. I could ask you all kinds of different questions about this one graph. Make sure you know it inside and out. All right, the second question was a little bit different. It was a consumer choice utility maximization problem, and it started off with the table below shows the utility. Apples cost $2, oranges cost $3, and the budget is $23. All right, so if you remember how I do this in class, I always start writing this stuff down. And I've already calculated, no, I haven't done it here. I need to calculate marginal utility first. So the first thing I have to come up with is marginal utility, and then I need marginal utility per dollar for both of these groups or both of these products. All right, oops, sorry, it's kind of ugly, but you get the point. Marginal utility per dollar. So going from 0 to 1 apple, 24. Going from 1 apple to 2, it's 18. Going from 2 apples to 3, it's 14, right? And then it's 10, and then it's 4. All right. Now the key is, what is the price of the apple? So I can compare this against two products. These apples cost $2. So the marginal utility per dollar is marginal utility divided by the price. So this is 12 utils per dollar. This is 9. This is 7. This is 5. And this is 2. All right, congratulations. We can do basic math. All right, let's do it for oranges. Marginal utility of the first unit is 27. Of the second unit is 24. I have the answer key somewhere, but I can't look at it. The next one's 21. The next one is 18. And the next one is 15. Now, to get their utils per dollar, I have to divide by the price of oranges, which was $3. So 27 divided by 3 is 9. Yes, that's right. 8. Oh, this is easy. 7, 6, and 5. And then the way I go through this, kind of mechanically, is I'm going to choose the purchase that has the most marginal utility per dollar first. And in this case, it's the first apple because it's 12. So I'm going to buy one apple. It gives me $12 of happiness per dollar, but it only costs me $2, so I have to subtract $2 over here. 23 minus 2 is 21. This is going to get messy. Sorry. The next thing that makes me the happiest is, well, one apple does at 9 utils per dollar, but it's the same thing with one orange. So I'll do one apple, one orange. One apple costs me $2. One orange costs me $3. So this brings me down to $16 left in my budget. Now, the next orange brings me 8 utils per dollar happiness. I buy that. Another orange. But the orange only cost me $3, so don't subtract 8 or something crazy there. Now I've got $13 left in my budget. I'm going to bring that 13 back up here just so I can subtract from it. All right, now, luckily, I have 2 that are equal. One apple, one orange. I'm going to buy one of each. One apple. Oops, that's my third apple. Hopefully I can see that. There we go. And my third orange, and that is minus 2 and minus 3. So that is down to $8 at this point. And then I look here again. Oh, you know what? I think I need another orange, right? Because it gives me the most happiness. 6 utils per dollar. There's my orange. Minus 3. That was supposed to be a 3. I'm down to $5. This gets a little confusing now, though. What makes me the happiest? Well, the next... oh, yeah, sorry. They're actually equal, aren't they, in this one? It's the next apple and the next orange, and I happen to know that if I buy one more apple and one more orange, that is $3 and $2, or 2 and 3, depending on how we're doing this. And that gets me down to 0. So my answer is 4 apples and $5. And the way to get the points on this question is to either do this math and show... Well, actually, you have to do this whole math. You have to show me this math and come up with 5 and 4. Or, sorry, 4 apples, 5 oranges. All right, that's part A. Now, part B gets a little more interesting. Part B says, Now we keep our dollars at $23, but now the price of oranges went up to $4 as opposed to $3. So you need to recalculate your oranges. Now, honestly, you can do this one of two ways. You could do all the math that I show you on the right, which is recalculating everything with $4. And what you'll notice is this used to be, when it was $3, it was 9 utils per dollar. Now, because the price went up, the marginal utility per dollar for every orange is lower. So we're getting less satisfaction out of that. And one answer you could give me is that you would buy more apples and fewer oranges because the marginal utility of oranges decreases at every level. Or you could do this entire amount of math for me, where you'd go through and say, all right, I'm going to buy one apple. I still have $23. So that's minus $2. I'm down to 21. One apple. And you know what? The next two things are going to be apples because it gives me 9 utils per dollar and 7. So I might as well do those two together, and that's minus $4. That should be 17, right? All right, and then I'm down to this point where I have $6.75 for an orange, so I'm going to buy an orange. And remember, it costs $4 now. So I'm down to $13 again here. I'll bring it back up here. And then I've already done this one and this one. I need another orange because it gave me 6 utils per dollar. There we go. Minus 4 is $9 left. And then the next one that gives me the most happiness, 5, no, 5.25. So another orange. There we go, minus 4. Now I have $5 left and things get interesting. So I look over here, 4.5 is not higher than 5. So I'm going to take an apple. So I've got 4 apples minus 2. Now I've only got $3 left. Now the next orange brings me $4.50 or 4.5 utils per dollar. However, the only problem is I don't have enough money to buy an orange. So what would I do? I would come back over here, buy the last apple, or I guess it's the last apple, isn't it? There we go. Subtract $2, and I'd have $1 left over. So my answer could be I would buy 5 apples and 3 oranges based on this marginal utility calculations that I did. Or you could also answer I would buy more apples and fewer oranges because the marginal utility per dollar decreases for all levels of oranges. All right, congratulations. See if I can finish this before my last 15 minutes of free screencast-o-matic that I'm using here. The last problem, or last part of this problem, is about elasticity of demand and income elasticity, and here is the answer. I'm just going to leave this one up because I don't think this one's complex. You had to do two things. You had to explain up here, which means what happens when income goes up, apples go down because they are an inferior good. And in this second problem, you had to calculate it correctly using the correct formula. Some of you did 20% over 10%. Remember, it's always change in quantity on top versus anything down here, whether it's income and elasticity, demand elasticity, supply elasticity. Quantity always goes on top. Therefore, it's 10% more bananas quantity sold when there's a 20% increase of oranges. Therefore, you had a 0.5 cross-price elasticity. Now, some people lost half a point here because they calculated this, but then they did not explain the relationship, which is these products are substitutes. All right, congratulations. I hope you got something out of this. If you have any questions, you can always email me. Otherwise, good luck if you're taking the second chance.